Hello folks, this is Toby Fisher. This is video 4. I'm going to dig into real estate formulas. So let me just start by saying if you have not watched the first video on real estate and the other video on goals, but particularly the one on real estate, I would say go back and watch that. This is a math video. So if you have done the math before, you're comfortable with the calculator, you're comfortable with Excel, this will be somewhat easier. If you are not comfortable with a calculator or comfortable with Excel, this may be challenging, and this you may want to come back to it a couple times. But so to the point around real estate investing, well, what qualifies me for real estate investing is I started investing. My first piece of property was in 1996, I'm sorry. And I've been investing ever since. Everything from apartment complexes to industrial, office, retail, in 6 different states right now. And so I know a few things. And I will say that if you've never done any real estate investing, you've done some real estate investing, I truly believe the math and understanding the formulas and having the discipline is critical. It's very difficult to be a successful real estate investor if you don't have some mastery. Now, I don't believe the math is extraordinarily complicated. Or the discipline is extraordinarily complicated. For some, this might be foreign. I would really challenge you to step into it. So again, if you haven't done this before, or you haven't watched the first video, go back and watch the first video. In the first video, I talked about creating a balance sheet for yourself, net worth, and understanding how to create a balance sheet. That's extraordinarily important just for the discipline of understanding a balance sheet. A balance sheet is a statement of your assets at a specific date and time. They're often done year end. They don't have to be, they can be, you could do a balance sheet on today's date. It's a static time. It's a specific time. You take all your assets, you subtract all your liabilities, you're left with your net worth. That's important for banks. That's important for your own personal well-being. And I think that's really just the first math formula for dealing with getting into real estate. The second, and I also talked about it before, so I'm only going to be highlighting this, was talking about your net income or your profit and loss. Unlike a balance sheet or net worth, net income or profit and loss, there's different terms. They're very similar. They can be used for businesses. They can be used for your own personal house. It is really a period of time. So we often hear about a fiscal year. So whether that's January 1st to December 31st or July 1st to June 30th of the next year. You can do it for a 30-day period. You can do it for a 90-day period. It has a start time and an end time. And this is really taking into consideration all your income less all your expenses, and that's your net operating income. Now, those are 2 statements I would encourage anybody to have some mastery around their own personal finances. As you go to evaluate a piece of property that you're not familiar with, that becomes challenging. And if you're not able to do your own net operating income, your own profit and loss, or your own balance sheet, where you have all the information. The reality is you have your bank statements, you have your house, you know what your mortgage is, your car payment, whatever the case is, you have access to all that information. So if you don't have those documents in hand and have the discipline on how to do that, it gets very challenging to then try to do the same thing on properties that you don't own, that you're guessing on numbers at some time. And so let's start with your net operating expenses. When you're analyzing a piece of property, and you'll notice that I've made all the numbers nice and even and round. This is not how the real world works, but I use this as an example, and I would urge you, again, if you haven't gone through this, if you don't know how to set up an Excel spreadsheet, or even to follow down, when I first started, I actually did a pen and paper and a notebook and would write. It was very tedious. If you look at this document, it was a very tedious document to handwrite. In an Excel spreadsheet, it's pretty simple to do. Certainly, if you're contacting me or email me, I can send you something. But understanding the math, whether or not you do it by hand or you know how to, operate an Excel spreadsheet, that means how to add, how to subtract, and it really doesn't get any more complicated than that. So let's just take a look at an annual operating expense. So you're looking at a piece of property. I'm going to pretend we're going to look at a 2-family piece of property, and I've made up these numbers. These are, you can see they're extraordinarily well rounded. It works to go through the math, and so go through the math. So real estate taxes, I put down $1,000. The reality is you can actually get real estate taxes. So as you're looking at a piece of property, a broker or owner or however you heard about this piece of property is going to give you a bunch of information. It is not likely that all that information is going to be accurate or complete, and it is your job as a professional real estate to get into a real estate that you are able to access the information. And I would tell you that if you own a piece of property now, you're going to go through the numbers with me now, but then go back and do your own piece of property, because you have the legitimate numbers. You know what the tax bill, you know what the insurance bills, you know what the water bill, the electric bill, whatever the case is, you know those numbers. For right now, I'm using very round numbers so the math works so you can understand the formulas. There is nothing more than addition, subtraction, multiplication, and division. Those are the only formulas that we're going to do. We will talk about how to come up with mortgage payments, but you're going to go on the computer or use a calculator. There's a bunch of different ways to do it. You are not going to have to figure out the math on that. Your math is going to be addition, subtraction, multiplication, and division. So back to the real estate taxes. I have $1,000 for real estate taxes. You can verify that. Even though in this case we're going to call it $1,000, you can verify that by calling up the town hall, and usually you can do it right online. You can go Google the property. They'll give you all kinds of information. Sometimes certain towns have comparable properties that sold. You a lot of times can find building permits online. You can certainly go directly to the town hall. I'm old-fashioned. If I'm buying a piece of property, and if I can visit the local town hall, and I'll go down the building department, I'll go down the assessor's office, I'll actually look at some of this information. But the first piece of information is your real estate taxes. I'm going to try to accomplish two things here today. I'm going to try to give you tidbits of information. The math we're working on is going to be simple, because my intention is that you at least have a basic understanding of the math walking out, but if I can throw you some tidbits along the way. When you buy a piece of property, you can find out what the real estate tax bill is for the current year. Sometimes tax bills do go up. They can escalate it to will take a year after you buy it. They could increase it just because they increase taxes, but they could increase the assessed value up to purchase price. That can dramatically impact your future cash flow. There is I don't have a perfect formula for figuring this out. You can, poke around down in the assessor's office. You can, some towns, really the assessed values are under market value. That's probably more common. Some states, they go right up to purchase price. South Carolina is a state, they go right up to purchase price. So whatever you bought the property for, if it's taxed, if $1,000 a year tax bill is based on an assessment that's 50% of what you are paying for the property, you can expect in about a year your tax bill is going to double. So, and that's in South Carolina. That's not every city, that's not every state. Sometimes it's a blend, but so you're trying to find out what the current tax bill is, but also expect you could see some increases in the future, and that can be difficult to know, and it's difficult to budget. The only thing we're going to do today is try to budget for the here and now, and you have the caveat that South Carolina actually will go up to the assessed value will go to the full purchase price. It takes about a year. So if you're buying at 50%, if you're paying twice what the city has the property is currently assessed for, your property tax bill in a couple years or a year or two will double. Most times it'll go up 10 to 20% when they see. If you're buying for below assessed value, which is unusual, you can usually go down the city and ask them to reduce it. But for today's, that's some nuggets. We're looking at $1,000 tax bill. The insurance, $100. Well, the insurance isn't really going to cost you $100, but we're rounding off these numbers just so I can show you a formula. How can you get insurance? You can actually call your own broker, give them the address, tell them what you're buying it for. They can actually give you a pretty reliable insurance quote. That's actually pretty simple. Water and sewer. If this is a rental piece of property, in most places the water meter isn't separated, so you're going to be paying water and sewer, and that's coming out of the expenses. For today's purposes, I put $100 because I'm trying to get you through the math. In the real world, maybe the owner gave it to you. A lot of times that information is actually public record. You can actually find it online, what was last year's tax bill. Sometimes you can't, and you have to estimate. Snow removal, same thing. Maybe it's not included. Maybe there is no snow removal. Maybe there is. Maybe the seller has some old bills. Maybe you call your landscaper and you say, listen, what would it cost me to shovel, to plow this thing? When we're doing the math today, I'm giving you the straightforward numbers, and I want you to get comfortable with the actual mechanics of it. But when you actually go out and look at a piece of property, you want to try to estimate the numbers as reliably as you can. It's not perfect. It takes some practice. I've done it enough times now that my numbers, so when I come up with my estimates, I go out a year later and I see how I did, and usually I'm pretty good. I'm usually pretty tight, but that takes some time. It takes some practice and takes some luck. So trash removal, maybe the city picks up the trash. You don't have to worry about that's part of the tax bills. Utilities, maybe the tenants pay all the utilities, or maybe you pay the heat bill. I put in $300. Again, I'm just looking to get numbers to be rounded. Legal, you might have some legal expenses. That's usually not that much. Management fees, if you're hiring a property manager, it's certainly not going to be $100. A lot of times it's a percentage of rent, or maybe you're going to manage it yourself. Repair and maintenance. Repair and maintenance can be a difficult number. $100 is probably not a realistic number, but I wanted to make the number round. And you'll see why the math, because there's a lot of formulas we're going to come to, and why it mattered in this case to make the math really straightforward. Repair and maintenance can be, 5 to 10% of the rent. That if you don't have a number, if it's a really new condition piece of property, maybe you estimate 5% of whatever the gross rent is. If it's beat up and needs some work, maybe you estimate 10%. Those have been fairly reliable. I put other $500. Well, I already know that a lot of my numbers, my insurance and my repair, are certainly very low. So I come up with a total operating expense of $2,500 a year. I did that purposely, so it's rounded off. Now, I came up with total yearly rental income of $24,000. That's less vacancy. So just hypothetically, just say that this property collects $25,000, and I figured $1,000 vacancy. Whatever, I'm pretending this is a 2 unit, so each unit pays $12,500, but you're going to lose, maybe a month's rent or something like that. It's an estimate. Depends on the market. So your total rental income, you should be able, this is a very important number to get into, you should be able to calculate what your legitimate rents, if the property's already rented, and of course they'll say to you, well, you can increase the rents. And I will suggest to you that do your homework. If it was so easy to increase the rents, the prior landlord probably would have done it. But a lot of times with a smaller deal, you might be able to increase the rents. You should do some homework to calculate, hey, is this rental income accurate? Whether that's looking on Craigslist, rental.com, whatever the case is. Other income, maybe there's some laundry in the basement. I don't really know. So total gross income, $25,000 a year. Again, I did this really so it's simple. So the math comes together. So how do you come up with your net operating income? So just like your personal budget, or if you're running a business, you take all the cost of all your expenses, you subtract that from all your revenues, your sales, your rent, whatever the case is. So $25,000 is your gross income. That's all your rents plus your laundry money, less a vacancy factor. Subtract out your annual operating expenses, and you're left with $22,500. It's a nice round, even number. Though it's not going to work like that in real life. So, so I want to go through this again. If you're getting overwhelmed with the math, I would suggest just go slow and go through this methodically so you understand where I'm coming up with the numbers and how we're doing this. Because when you go into another piece of property, the numbers aren't going to round off, and you're not going to have, some of the numbers aren't going to be 100% be able to be validated. So you'll get estimates. Some of the numbers you will be able to get validated. So there's going to be some guesswork in this, and I promise you, the number's not going to round off to be $2,500, nice and even as far as expenses, and your total net operating income is $22,500 a year. Getting to your net operating income in any business is critical. It is partly an estimate. The better and more surgical you can do this, the better you're able to analyze a deal. So going back to your house, I talked about doing, calculating your own net worth, because you know your own assets. You know what if you have a car, what do you owe on the car? What's it worth? You know how much you have in the bank. If you own a house, you know what the house is probably worth. Don't make up a number. Use, if Zillow says it's worth $100,000 more than you think it's really worth, use the lower number. There's no point in lying to yourself. But by doing it in your own household, you're working with reliable numbers. It's the same thing with if you're looking on your net operating income for yourself. What's your salary? If you have other income, interest, whatever, you can look at that, and then you can also know what your expenses are. So for your own home, you have the ability to get those numbers. So that's a place to practice in. But on this one, we came up with $22,500 is your net operating income. Now, I'm going to talk about capitalization rate. You may have heard of cap rate. People get overwhelmed by this, or maybe not. Maybe you're a seasoned investor and this is really redundant. And if you are, feel free to fast forward or whatever you want to do. But if you're new and you don't know what a capitalization rate is, or a cap rate, this is a really important number. And you cannot calculate this number if you don't have net operating income. So as you go through that entire thing, you end up with a number 22,500. For purposes to make the math simple here today, I have just simply said the house costs $300,000. Well, we did this on purpose. So the capitalization rate is it's so that you can compare two houses. So you'll say, hey, one house is 300, one's 500. What's the better deal? Well, partly depends on condition, location. But part of it is if one's a 4-family and one's a 2-family, you kind of have to compare apples to apples. You have to, and the cap rate does that. Because what the cap rate does, it says, what is the income relative to the purchase price? So in this particular piece of property, I've just said it's worth $300,000, and it has a net operating income of $22,500. So $22,500 divided by $300,000, the purchase price, gives you a capitalization rate of 7.5%. Another way to think about this: if you had $300,000 and you stuck it into the bank and it paid 7.5%, it would give you $22,500. Okay, so that's the capitalization rate, and that becomes really important if you want to be an investor. Figuring out net operating income, being able to drill into these numbers, being able to calculate, being able to take, okay, this is the net operating income, this is the purchase price, this is what I think a cap rate is, and this is how you can compare multiple pieces of property. I mean, you can even compare different types of property. You can, whether it's a 4-unit apartment building or it's a retail store, with the cap rate, you can compare different states, different areas, but your cap rates are going to be bogus if your net operating income isn't reliable. And so people might wonder, well, what should I get for a cap rate for an apartment building? That's a very difficult question to answer. that's going to depend on the market, the quality of the property. Is it an appreciating property? Is it baseball bat management? You buying a property that's in a rough area, I call that baseball bat management, or you buying an area that's really up and coming. And so those cap rates can vary. On residential property, it can vary anywhere between, nowadays, 5% to 10% would not be, 10% would be an extremely profitable deal. If you did find a 10%, it's probably in a rough neighborhood and you have to work to get that money. Or maybe it's a house that needs a lot of work and you're a handyman or you have construction experience and you can buy the house cheaper, put some money into it, and so you can leverage some of your skill sets. But for the argument's sake, I put down 7.5% as a cap rate on this. And you can compare different things, different properties. So you look at two properties, you compare them, and if you do this on Excel, you actually would have a sheet for each different property. That's how I've done this. If you're new, I would tell you probably just do it by hand to begin with. Pull out a calculator. Have yourself a calculator, some pencil and paper, and so that you can methodically go through it. If you feel that you have the math and you're ready to go, outstanding. So we've come up with a 7.5% cap rate on this particular piece of property that we're buying for $300,000 that makes $22,500 a month. There's another investment metric that people talk about: cash on cash return. I think it's important that you understand cash on cash return. It's not my favorite metric for deciding whether to buy a property, because I'm going to show you the more cash you put down, the less cash you put down, potentially the higher the cash on cash return is. In fact, if you put 0% down and you make $10 a year, your cash on cash return is actually infinite. And we'll walk you through the math on that. So I'm going to walk you through two of them. So we bought this property with 25% down. So again, this is just subtraction, multiplication, addition, division. That's it. So the house is $300,000. You're going to put down $75,000, 25% down, which is pretty typical for a multifamily. If you're doing first-time home buyer FHA, you can get it lower. But for argument's sakes, work on the math so that you understand how the cash on cash works. So your mortgage is going to be 75% of the purchase price, or $225,000. Now, where do you come up with your monthly mortgage payment? There's three components to a mortgage payment. You can find applications right on the website how to do it. You do not need to calculate your mortgage payments. I do a financial calculator. I know how to use it. You don't necessarily need that. If you do, it helps. Every calculator is different, so I'm not going to teach you how to use a calculator, but I use a calculator. But you can go on the internet and you can Google in your mortgage payments. Just be careful that, for example, someone automatically plug in PMI or ask for your email. There's plenty of free ones that are pretty easy. So you put in the amount you want to borrow, how long you want, the interest rate that you think you're going to get, and it'll give you a monthly mortgage payment. So for this one, we're going to put down 25% of $300,000. That's $75,000 down. We're going to borrow $225,000. We're going to do a monthly mortgage is going to be amortized. So amortized is the term. How long is the loan going to be? So they figured out this brilliant mathematical formula so that your monthly payments are equal every single month. So each month you pay some principal, you pay some interest. At the very beginning, it's a lot of interest and a little bit of principal. And then as time goes on, it becomes more and more principal and less interest. And after the end of the term, after the term that it's amortized over, in this case 30 years, you're going to owe zero. So your very last payment's probably going to be 99% principal and just a little bit of interest. So in this case, I picked 5.3%. I don't care whether that's a realistic number. The reason I picked the number because it makes the math really round. For those who actually use the calculators, you're going to see it's a few pennies off. So maybe it's 5.31%, whatever the case is. But I wanted to make the math simple so I can show cash on cash return. So your monthly payment is $1,250 a month times 12 gives you $15,000 a year. So you are borrowing $225,000, 30 years, and you're going to pay $15,000 a year in mortgage payments. Okay? So what is your cash flow after your mortgage payment? So you have $22,000 in net operating income that takes all your expenses out. You subtract out $15,000 for your mortgage. You're left with $7,500. So how do you get your cash on cash return? Well, you invested $75,000 of your own money. You got $7,500 in after mortgage profit, and that gives you a 10% cash on cash return. So that's the math. You'll see that I picked the math to be simple. It may not seem simple, but it's all rounded off, so the numbers came off to be pretty. I spent a little bit of time trying to figure out, okay, how can I do this example and give you all the math so it gives you nice round numbers. I would urge you to take this. If you need a freeze frame, if you need to watch this again, take a calculator, take an Excel spreadsheet, whatever, however you want to set this up, so you can run the math yourself, so you can see, so you know how to do the calculation. Because if you can't follow what I'm doing right now, you're never going to be able to do this on a deal that you don't have, nice round numbers. Okay, so on this deal, you got $7,500 divided by 75,000 is 0.1, which is the equivalent of 10%. So you got a 10% cash on cash return. A lot of investors think cash on cash return is the most important way to invest, because the more you can leverage your money, the more you make, right? And that does work. I'm a little bit hesitant to use this as my only criteria because it doesn't really take into consideration the quality of the house. And as if you were able to buy 0% down, your whatever your cash, you may make $1 a year. Your cash on cash return is infinity, because 0 down divided by $1. Well, you do the math, it comes out to be infinity. Let's do a cash on 10% down. And I'm just show you just more in real terms what that might look like. So you're buying the house for $300,000. You're putting down 10%. That's $30,000. Your mortgage is $270,000. So that's a 90% down mortgage. You're going to do the monthly payments. The same, 30 years amortized over 5.3%. It just pretty much worked. I ended up with monthly payments of $1,500. That comes out to $18,000 a year. So because so basically you finance an additional $45,000. On the first way you put down $75,000, on this one you're putting down $30,000. So you're paying an extra $3,000 a year in your mortgage payments. Okay. So you take your cash flow, $22,000 minus your $18,000. That's your yearly loan payments, your debt service, and you're left with $4,500. So where you were making $7,500 before, you're only making $4,500. But when you go to the cash on cash return, you take $4,500, you divide it by 30,000. You're making 4,500. You put down 30,000. You end up with a 15% cash on cash return. So you'll say, "Wow, I do better. The less I put down, you do better." You do better, yes, but it's more risk. And one of the things that's important is that your cap rate is above your borrowing cost. So that's really important. I'm gonna re-sum this up a little bit because we threw a lot of math. We talked about creating your net worth. We talked about creating your own net operating income for your own personal house, your own business, whatever, just so you can get familiar with it. Now dig in. If you own a piece of property, maybe you rent a house, okay? You can actually figure out, okay, what is the expenses for the house? If you live there, you're going to know better. Maybe you have to look up the property tax bill, whatever the case is. You should be able to look at your own piece of property. And then if you own the piece of property, well, if you rented it out, how much would you get? If you were renting it, you already know what you're paying for rent. So practice on your own personal, the things that you know, because that'll run you through the math. When you start looking at properties that you don't own, it gets more difficult. Sometimes you're guessing. Sometimes the owners give you good information. Sometimes they lie to you. And so you want to verify that information. Now, in this scenario, your cash on cash return increased the less you put down. That mathematically doesn't work if the cap rate is below your borrowing cost. I won't go into the math on that one. It isn't important, but conceptually, we're in a market right now. So it is April 24th, 2023. Whenever you're watching it, and over the past 9 months or so, we have seen interest rates go up from like 3.5% to 6.5%, and we've seen prices maybe come down a little bit. But when prices don't come down, maybe rents went up a little bit. That means your cap rates, they didn't go up dramatically. Your cap rates have stayed pretty much the same. So that means you might have bought a piece of property at a 5 cap a year and a half ago, but your mortgage payment was 3.5%. So the math worked better. Now your borrowing cost, in many cases, equal or above your cap rate. When your interest payment on your mortgage, and you can run the math as you're starting to do this, that's what makes this market more difficult than most to buy in and make money. When your cap rate is lower than your interest borrowing cost, this really messes up your numbers. And that means a lot of times for a lot of people, they might have zero, they might not be making any cash on this because, they might be 0% cash on cash return. Maybe it's still a good buy. There are a lot of other things that make real estate an important and valuable investment. You get tax write-offs through depreciation. We're not going to go through that. You get appreciation. You get principal pay down. You have an asset that increases with inflation. Particularly residential seems to do very well long-term for inflation. My first piece of property I bought in 1996 for $118,000, sold in 2021 for $700,000. So that works out pretty well. So we covered a lot of math. Hopefully that was helpful. If you want to be a professional real estate investor and you didn't understand what I said, either go back and watch the video again or find somebody else that you resonate better with who can explain it. I truly believe that if you want to be a responsible investor, you know how to come up with net operating income, you know how to come up with a cap rate, and you know how to come up with cash on cash return. I think it's very difficult to be a real estate investor if you're not able to do the math. And again, it's multiplication, it's division, it's subtraction and addition, and that's it. The only thing that's a more complicated formula is the amortization, which you're not going to calculate yourself. You're going to go on the internet and you're going to plug it in, and it's going to give you monthly mortgage payment, and then you multiply it by 12. So hopefully that was valuable, and I wish you all success. I love the real estate business. It's been it can be challenging. But it is a long-term get rich slowly program, and it works.